Good afternoon. I want to welcome you to the Commodity Futures Trading Commission for today's roundtable. This is, I think, the 23rd roundtable that we've had at the CFTC these last couple of years. But this one's a little different than most that we've had. Most that we've had have been roundtables focused on Dodd-Frank's swaps market reform. We've had a couple on customer, I think 3 on customer protection that weren't specifically Dodd-Frank. And like those, this is not specifically Dodd-Frank. Today's roundtable is about the integrity of financial market benchmarks. The CFTC and the Financial Services Authority are co-chairing an international effort around this called the IOSCO Task Force, IOSCO for International Organization of Securities Commissions, Task Force on Financial Market Benchmarks. And the task force is focused on developing international principles for benchmarks and examining the best mechanisms or protocols for a benchmark transition if needed. In January, the task force published a consultation report, and we're hoping to finalize a report in this spring. Last week, we were able to have a very productive roundtable in London to get public feedback, and that record will be in the that roundtable will be fully in the consultation record. But we also wanted to offer an opportunity here in the United States to get input as well, and this will be fully in the record, as Jackie assures me. I do want to thank Martin Wheatley, who is about to assume the role of running the Financial Conduct Authority, but it's still called the Financial Services Authority, and his colleagues as we're co-chairing this task force, but also because they've been just a terrific partner in vigorously pursuing what has been some hard cases, but in the enforcement area regarding manipulative behavior surrounding LIBOR and other similar rates. Jackie Mason on my left, the head of our international, Robert Rosenfeld, I think is also over to the left from international, will be leading a lot of the questioning here, but also Matthew Hunter from our Division of Market Oversight, Scott Mixon, who you may not have yet met because he's our acting chief economist, and his colleague Richard Haynes from our Office of Chief Economist. Oh, and Tom Leahy also from their Division of Market Oversight will be leading the questions. I think the questions come down from the consult to 5 key areas, and Martin and I did this last week. We mentioned these 5 as well. Let me try this. It's also in some prepared remarks that I have. But first, what breadth or scope of indices or benchmarks should be covered by this report and our recommendations? Just to mention, though, there's been much public attention on LIBOR and Euribor and similar rates. What in London we started calling at the roundtable the IBORs. The task force consultation actually includes indices and benchmarks more broadly, such as equity indices. So one is a question of scope. Second, regarding best principles for benchmarks, which is the main thing we want to have as a result of this, how granular or detailed should our recommendations go? The further we get into details and granularity, we might be covering important territory, but then it's sometimes hard either to find international consensus or even to find something that applies more broadly across these benchmarks. And one of the things we talked about in London is maybe we need to get more granular and detailed around the IBORs and some of the things we know have happened there, and we could have some more broad principles that include these equity indices and so forth. Third question is, what regulatory oversight, if any, should there be for administration of benchmarks? In London, you're probably well aware that the UK Parliament passed in December explicit legislation that there's regulatory oversight of LIBOR now, and in front of the European Parliament, they're considering some broad oversight, making the actual administration of benchmarks a regulated activity. We do not have something similar here in the U.S., but that is part of the consultation process too. What's appropriate in that regard? And then I think fourth and fifth get to some questions, particularly we're looking forward to hearing from you today, is the question of transaction and how things are based to transaction. So do you agree with the statement in the task force? The task force specifically said a benchmark should be, as a matter of priority, anchored by observable transactions entered into at arm's length between buyers and sellers in order for it to function as a credible indicator of prices, rates, or index values. So we're seeking advice. Do you agree with that? We got 51 letters, 51 actual letters in the consultation. And I would say most of the letters actually did agree with that and then had some caveats or asterisks or but-fors, but agreed. So as a part of that question really is, to the extent that there are short time periods, and I note short time periods, with insufficient levels of actual transaction data, to what extent might non-transaction information, such as bids and offers and various extrapolations, be referenced? Because in the 51 letters, that was kind of the, most people seem to agree with the premise, but then had the question of when there's short periods of illiquidity or it's holidays, what do you refer to and things like that. One note was, the jet fuel market sometimes, or there's only a few transactions a week. What do you do when there's not transactions? And then fifth, and this may be the most challenging set of questions, how do we address transition when a benchmark is no longer tied to sufficient transactions and may have become unreliable or obsolete? Now, the consultation raised this question in two contexts. First, prospectively. The consultation suggests that contracts referencing a benchmark would be more resilient if those contracts had embedded in them a contingency plan for when a benchmark may become obsolete. And as we were just getting together for this, Tom Dees of the FMC Corporation handed me a document which was oh, here it is. Can I say this publicly? Yeah. Okay. So a 1991 loan agreement, I think it's a 1991 loan agreement when Tom was over at the Scott Paper Company, that had a fallback in a loan that if it wasn't based on LIBOR plus, can I say the spread you were borrowing at? It's very attractive. If it wasn't based as a 31 basis points over LIBOR, it could be 43 basis points over something called an adjusted CD rate, for instance. So there was a fallback, a contingency plan, so to speak. So our consultation asked that to make contracts, whether they're loans, whether they're derivatives, more resilient if a benchmark becomes obsolete, should they embed right in each of those derivatives or loans a contingency plan, a fallback, a living will, so to speak. Perhaps more challenging, much more challenging possibly in the context of LIBOR, is the consultation asks what to do about existing contracts that reference a benchmark that actually becomes obsolete if the contracts don't have an effective contingency plan. Maybe they have a fallback, but the fallback wasn't really meant for a scale like what we're facing with here. And I note that in many derivatives contracts, there is a fallback if there's not a LIBOR being quoted on U.S. dollar LIBOR and the like. But is it really an effective contingency plan if the whole thing had to transition? So that's the consult, and those are the 5 key questions. And I note on transition, there's 2 pieces of it. I thought I'd just, before I hand it over to Jackie and my colleagues, just give you a couple of thoughts from where I see this. I do agree with the consultation report statement that any benchmark to be reliable and have integrity, it's best to be anchored in real observable transactions. I don't know what it means to be a benchmark if it's a benchmark not anchored to something. And I don't mean a transaction every minute of every day continuously fed through a streaming transaction quote board. But if it's not anchored, I don't know what it means truly. And I think it's only through real transactions entered into at arm's length between buyers and sellers that we can actually be confident that prices are discovered and set in accordance with the market. When market participants submit for a benchmark rate that lacks such observable transactions, even market participants operating in good faith, they may stray from what real transactions would reflect. And when a benchmark is separated from real transactions, it's more vulnerable to misconduct. Now, as we examine the questions in the consult, the IOSCO consult, I also think it's important to keep in mind what we've learned recently. Foremost, LIBOR and other such rates around the globe, and now I'm talking more about the IBORs than maybe some of the other benchmarks. But these LIBOR and other similar rates around the globe may no longer be grounded in real transactions. The market for interbank unsecured lending has largely diminished over the last 5 years, and some have said it's essentially non-existent. In 2008, Mervyn King, the governor of the Bank of England, he's still the governor of the Bank of England, said of LIBOR, "It is in many ways the rate at which banks do not lend to each other." And that was a direct quote from a parliamentary hearing. The number of banks willing to lend to one another on an unsecured basis has been sharply reduced, and it's a number of reasons. They've been well researched, but it's economic turmoil, including the 2008 crisis and the European debt crisis, the downgrading of many of the banks' ratings themselves. There was a time that this was almost thought of as, quote, a risk-free rate, and that's gone away. But in addition, there have been other changes. Central banks are providing significant funding directly to the banks, of course, throughout the crisis and post the crisis. The banks are managing demands on their balance sheet where they're less willing to actually have part of their balance sheet committed to interbank lending. And there have also been significant changes to the Basel Capital Accord. Basel III includes, for the first time in the capital rules, specific provisions related to trying to lower the interconnectedness of the system. Secondly, there's something called the liquidity coverage ratio that makes it prohibitive, really, to have interbank lending more than 30 days. I don't mean today to be a technical expert on that, but that's what a bank, one of the banks that was in the room last week told us, and on Friday I was starting to research that, and I realized, yep, the bank was right. It's really hard under the liquidity coverage ratio to lend for more than 30 days. We've also learned that LIBOR, central to so much borrowing and lending in our economy, has been readily and pervasively rigged. And I don't choose those words lightly, but how else can we describe what we've seen in these three cases where the CFTC, the FSA, and the Justice Department have come together? The misconduct, if you take all three cases together, spanned many years. It took places in offices in several cities around the globe, and I would say several cities. That's 3 or more cities for each of the 3 banks. It included numerous people. In one case, it was at least 3 dozen, but in all of them, it was a dozen or more people at the banks. It included management, and in at least one case, up to the executive suite. It involved multiple benchmarks. It wasn't just one benchmark rate. And in each case, each of the 3, there was evidence of collusion, what we technically call aiding and abetting, including other banks. And in the UBS and RBS cases, one or more interdealer brokers, so-called voice brokers, were asked to paint false pictures to influence submissions of other banks, i.e. to spread falsehoods more widely. And then lastly, in the Barclays and UBS case, there was also reporting falsely low borrowing rates in an effort to protect the bank's reputation. You've read about all that, but it's sort of when you pull it together what we've seen, that it was readily and pervasively rigged. We also can observe significant amounts of publicly available market data that raises questions about LIBOR even today, not about 2008 and 2007, but 2011 and 2012. Many of you have probably been subjected to some of our chief economists and my sort of slideshows that I, for the press, you've seen included in the European Parliament testimony I gave in October. But a comparison of LIBOR submissions to the volatilities of other short-term rates reflects that LIBOR is remarkably much more stable than any comparable rate in the short-term money markets. Furthermore, a comparison of LIBOR submissions to the same bank's credit default swap spreads. If you look at one bank and you say, where might their credit default swap spreads be, or broader market rates in the foreign currency markets, highlights there's a continuing gap between the LIBOR submissions and what those other market rates tell us. Now, these are just observations, but I think whether it's Mervyn King's observation or the observations you can draw yourself by reading the 3 orders against Barclays, UBS, and RBS, or anything you can pull off just a Bloomberg screen that's publicly available, leads to some real questions about the reliability of LIBOR and these other IBORs. So I think the IOSCO consultation comes at a critical juncture. Given what we know now, I believe it's critical that we move to a more robust framework for financial market benchmarks. That's what this IOSCO consult is trying to address, particularly for those benchmarks for short-term variable interest rates. I think given what we know now, it's critical that we discuss, and I do mean discuss, procedures and mechanisms for transitioning. That's why I'm glad Bob Pickle from ISDA is here, because you've handled so many transitions in the past, maybe none as wide as this one and maybe as challenging as this could be. But what to do about transitioning. We do know that Martin Wheatley has already said that there shouldn't be any Canadian dollar LIBOR and Aussie dollar LIBOR and so forth, so there's some needs for transitions there. But more challenging would be if the judgment ultimately was that sterling LIBOR, U.S. dollar LIBOR, was not reliable enough. So those are the questions and some thoughts from me. And I'm going to turn it over to Jackie and try to listen. I think I have to probably leave at some point, but I'm going to try to stay as long as I can. But I thank you again for coming. Also, I think Commissioner Chilton might be on the line. I don't know if he wanted to say anything. No? And any other commissioners, if they come in or out during the day, might have something to say. So, Jackie.
Thank you, Chairman Gensler. I just wanted to reiterate in very short form some of the points Gary made before we get started. One of those, this is an IOSCO consultation, so we'll be largely following the public consultation document. Many of you commented in written form already, so I just want to thank you for that. But also to highlight the point of the people sitting around today. We really tried to focus on the users of the benchmarks, which is why you see this sort of makeup of the roundtable. We wanted to get your voice and your opinion on the consultation. Sometimes it gets lost a little bit, and we wanted to make sure we got that feedback. There's a mix of course, other people on the roundtable and everybody else. All your voices are important, but I just wanted to highlight why this particular makeup of the group today. We did not ask for opening statements from each of you, but rather, given the short time of this roundtable, wanted to just jump in and start right away with questions. But we did want to start with sort of an open question, which maybe gives you the latitude to make, some key points. And that is, as users and others of the benchmark, is there any key concerns you have that we can just draw out from the beginning before we start going step by step through the consultation document? So I'm giving you sort of this broad question and leaving it open for you if you want to speak. And as you want to speak, just raise your flag and we can call on you. And as the chairman mentioned, anybody here may then follow up with some questions as well. So that's my opening questions. What are the concerns that you have in a detailed or broad way looking at benchmarks, whether you want to go with the BORs or broader benchmarks? Nobody wants to take your first take at this. Is it too broad, too open?
Hi, Bill DeLeon, PIMCO. Thank you very much for the opportunity to speak today. I'd like to point out that our concerns are much more geared towards the prospective nature of changes. The market is incredibly varied and widely used, both from what is traditionally known as the swap market, as well as from securities that use indexes in their valuation on a day-to-day basis. Our concern is that any change that be made not affect the liquidity or pricing in an adverse manner to the existing securities that exist, as well as not disrupt the market. Interestingly enough, if you think about the existing U.S. fixed income market, over 10% of it is based on floating rate indexes alone. So given that, and then if you look at the non-agency mortgage market, it's an even larger percent of the market that is driven off of index like LIBOR. Any sort of change to that index will have massive implications to how those securities are valued and traded. So we have very large concerns about that. Additionally, there are a lot of end users who have done asset swaps or done transformation of issuance of debt, and they're here and they can probably speak more eloquently to the issue than I can, but take a simple situation where someone issues debt and they want to convert it to floating rate, or conversely, they want to convert floating rate debt to fixed rate. Well, they've done an issuance of a security, and then they've done a derivative trade on top of that to match the the floating rate to transform the fixed rate component. So they effectively don't have any index risk. So if you change how the index is treated and don't do it simultaneously for both the asset and the hedge, you will actually create unintended consequences where the relationship no longer is perfect and you have substantial impacts to those end users.
Well, noted, and we're going to get, I think, a little bit more into that in a bit. So I want, transitioning into one of the 5 main points that the chairman highlighted is really scope. I know it's not on the agenda, but it was the first point in the consultation document, and it's frankly a very tough one for the task force members. So the scope presented in the consultation document is that the principles should apply broadly to all assets, all benchmarks used in the financial markets, not including when the government functions as a calculation agent. We wanted, though, what we're grappling with is the principles need to be granular enough to be meaningful. So taking into consideration principles that can apply across all benchmarks, but yet detailed enough to have an impact. What is the suggestion of this group and of roundtable participants regarding the scope? Do we have the scope right? Should we include all benchmarks used, given that there may be concerns that go across benchmarks? Or should we have a more narrow focus?
Also, if I could just add something, in London, there at the stakeholder meeting, there was some discussion around the suggestion that the IOSCO principles, if drafted at a significantly high level, could apply across the board, but then certain more granular sub-principles could be made applicable to certain systemically important, broad-based, public good type LIBOR and other benchmarks. So there's a variety of ways of going about this, but we would like to hear your thoughts.
So, Joe, I'm sorry, you had the... And just let me make a note, when you do want to speak, just please put it up. Okay, go ahead.
Okay. Thank you. I think you've seen a measured approach to scope, and taking into account the IBORs, because that is where the problem arose, and allowing the market to evolve, come up with these benchmarks. Obviously, it's been wildly successful. And later on in the development, there has been some type of bad action where it's appropriate for a regulator to get involved and correct that bad action. Balancing out how you stay ahead of the curve to prevent bad action on other benchmarks is a difficult one. But I think erring on the side of not doing any harm is really the right approach, and stepping in where there is a problem, and I think you've made a very compelling case for there being a problem, is appropriate. But to take a very, very broad brush and bringing in a lot of stock indices and things like that, I don't see the reason why that would be needed or appropriate at this time.
Okay, others? Gary?
Thank you for the opportunity. So I think from our view, it looks, and just to quote Robert a bit, if you take the broader base and include all indices, which I think is probably the right approach to have, you then potentially lessen the importance of the systemic indexes, right? So I think what you need to have is a more of a two-pronged approach, or maybe a bifurcated market where there are best practices or recommendations across the broad spectrum of indices, but knowing and understanding that the systemic indices need to be be protected and need to be governed at a certain level, right? Whether that is a deeper, more regulated level or not, to be determined. But I think I don't think you could go across all indices with the same level of regulation without potentially doing harm or losing indices in the middle of that. And even worst case scenarios is not letting the index market actually begin to create new indices, right? So I think there needs to be sort of an understanding that there are indices that need room to grow and time to evolve. So that regulation and that oversight needs to kind of be somewhat balanced.
So not creating, I have a follow-up question for you. So not necessarily creating barriers to entry on how deep we go on all benchmarks, but question on where you draw that line. So you said importance. Benchmarks that have some kind of importance or a different relevance for the regulators. Where would you draw the line? What?
For us, from my view, it would be really along where you have a systemic impact, right? So you're talking about the IBORs. There is a systemic impact when those go awry, and there's a systemic impact when the overall general public begins to either discount or mistrust that particular index. So it is a bit of a gray area in terms of where you draw the line, but I think as a collective, as what regulators do, you begin to kind of define that in transition. And I think that is sort of that key component is how do you transition into a benchmark that may not have a systemic importance, but has an economic importance to a specific trading activity, and then that transition into becoming systemically valuable, systemically important, that would have a very big or negative backlash to sort of how the systemic marketplace views that index, right, as we see in some of the IBORs.
Mark
Seitzer, General Motors Pension. As a significant user of instruments that are tied to financial benchmarks, I think we would take the perhaps a broader view than some of my fellow panelists, insofar as we would like the principles that are agreed upon to apply to both indices that are offered or administered by public bodies, as well as those that are commercially available, in particular, commercially available indices that would find their way, or at least not be prohibited from finding their way into either exchange-traded instruments or privately negotiated derivatives, insofar as the administration and the reliability of those benchmarks would impact valuation, cash flows, performance measurements, and the other significant uses of those benchmarks.
Yes, Tom.
Tom Callahan, NYSE Euronext. In terms of the question of where to draw the line, I think Gary's point is a good one in terms of if you could distinguish objectively what is a systemic index versus non-systemic, that would be a great place to start, but it might be hard to get consensus around to the market as to which is which. To me, the logical place to draw the line would be to look at the underlying commodity. The types of challenges that we're all grappling with around the boards tend not to exist when we're talking about reference benchmarks where the underlying commodity is liquid, transparent, perhaps exchange traded, perhaps centrally cleared. And I would say that while the general principles could certainly apply to reference benchmarks that meet those criterion, the deep challenges, as we all know, are in underlying commodities where they're perhaps bilateral, probably not centrally cleared, where there is very low or no transaction volume. So I think that's a far easier and far more observable and objective place to draw a line in terms of transaction volume and level of regulation and liquidity and underlying transparency.
Okay, Bob.
Bob Pickle from ISDA. I guess I was just going to point out that, as we note in our comment letter on the IOSCO consultation, there's kind of a level that may exist, whether it's the market abuse directive in Europe or the powers under Dodd-Frank now, perhaps not before Dodd-Frank, in terms of false reporting here in the United States, where that could provide some starting level of protection, and then it really is a question of how far beyond that one would need to go for these more systemic things. So there is a base there. I think from our view, it's really where do we go beyond that base for these indices.
You know, when in listening to you, you know, I'm thinking of the GIFMA principles, and I think I hope there's a consensus that those types of principles would apply across the board, but that where the issue is, as Jackie said, the level of granularity that you might go beyond to apply to the more systemically important board type of benchmarks. So do you agree that there's at a certain core level, every benchmark should be subject to a high-level principle that addresses, for example, transparency, clarity of methodology, addressing conflicts of interest?
I think that's true, and we've certainly looked at the GFMA principles, and I've talked to Randy about those, and you know, we look at the particular index that we sponsor. We're looking at it in light of the Wheatley principles, and we'll also look at it in light of what comes out of the IOSCO consultation. Yeah.
Microphone. Rosa?
Rosa Brentishmets from NYU. I agree with the suggestions that Thomas just made. I think the way I would draw the line is to think about how a particular benchmark is set. If it is set under a committed quote system or uncommitted quote system, it would have to be revised. And if it is, for example, administered by a trade association, that would be problematic as well. So I would analyze it in terms of the methodology and the inputs into the index. And of course, transaction-based indices may also be manipulated, though they're less likely. But there's also transaction-based indices that lack data for a very long period of time, for example, sometimes in CDS markets. So those types of indices, I would also take a closer look. I think indices relating to stock prices, for example, that trade all of the time would be much less of a concern. So the approach essentially would be where is collusion and manipulation more likely to occur, and that what features make it easier to collude and manipulate, and that's how I would go about it.
It's interesting. Randy?
So just maybe to answer the question on scope and go back to that for 1 second. So what we've articulated as GFMA in our principles is, I'd say, a relatively high-level set of principles. And the reason for that is we don't see this as really a one-size-fits-all. Reflecting the facts that we've really discussed so far today. We have at one end of the spectrum listed markets with end-of-day closing quotes to another end of the spectrum where you have much less liquid markets, relatively little trading, and then things in the middle like the credit markets where we might have trace reporting, but a third or half of the bonds in some of these marketplaces don't trade each day. And there may or may not be an end-of-day type of quote or close. So we don't see it as a one-size-fits-all. We think the level of granularity needs to be sufficiently at the right level so that it's meaningful, but not so granular that we're trying to prescribe a one-size-fits-all approach for a wide variety of asset classes and market structures.
Possibly capturing the threads around the room, and I do see Rosa, thank you. I think you're the only person that came to both roundtables. Is that right? Yeah. Though ISDA was at the other roundtable, just represented by your twin. But I think what I'm hearing around the table is consistent with what we heard from the roundtable in London, largely consistent, except for maybe the comments from Joe, that we have a set of principles as we put out in the consult that would include the equity indices, that it might be, you know, there's some principles like thou shalt not manipulate, that, you know, and more than that, but transparency and some codes that could be broadly, but then we might go more deeply with some more granularity in particulars, for instance, around submitters. There aren't really submitters in an equity index that's like the S&P 500. But there's submitters in some of these survey-based rates. I mean, that felt like where we might be hearing and where we were from last. Is that right,
That's right.
Jackie? We didn't embrace this word, a systemically relevant benchmark versus systemically not, last week. Now, that doesn't mean we couldn't, but I didn't feel a lot of warmth around the room that we were going to go try to figure out how to define that. But more that there'd be more granularity on survey-based rates rather than exchange-based rates. And there was a letter that sort of we used a little bit. It was from I can't remember the name of the group, but it was a bunch of European exchanges. What was it?
FESI, Federation of European Security Exchanges.
Yeah, FESI, that sort of laid out a certain level of it that was helpful. So.
Just to Bill DeLeon from PIMCO, just to follow up on Rosa's comment, and I sort of going back to something you just touched on, it is important that I think that one of the principles not be that everything is transaction-based, because there's certain indexes which are composites of other things, and I think you need to very clearly carve those out. So as you alluded to, equities is one, fixed income indexes are others. As Randy pointed out, while certain bonds and CDS trade during the day, they're not all continuously quoted or contemporaneously quoted at the same time. So when you have indexes where there's public information, but it's not all at the close, you need to be careful. So I think there is some form of granularity. I think we would agree in principle, not to put words in your mouth, but that the S&P 500, right, doesn't always get quoted. You can trade the futures, which trade quoted all the time, and then you can close the index based upon the composite. I think we would agree in principle that not everyone's trading the index of stocks all day long as a quoted market. You can trade them via EFP with dealers, but it's not the same thing. And I think that you need to have breakouts for different type of indexes like that. So the IBORs clearly should be treated very differently than equity indexes or commodity indexes.
I think it's a good point, and it kind of pulls it all together before we move on, which is there will be some principles that will be directed to transaction-based benchmarks, and that's where we need to be clear that we have a high-level benchmark that will apply across the board, but then some more granular benchmark principles applying to certain benchmarks. And I think that's sort of where we're headed. I think today's discussion was helpful in helping us kind of think about what characteristics should go into level 2 and how we should think about the high level versus the more detailed. Moving on.
Can I just ask, Bill, just though I think I followed what you said, there was one piece I didn't. So I did follow that you're not going to have a continuous transaction stream at every moment, and that's why the consul said, as a matter of priority, anchored by observable transaction. Anchored doesn't mean, every minute of every day and so forth. But what I didn't follow is when you said composite indexes. What did you mean? Can you highlight that?
Well, the S&P is a composite of 500 different instruments. So, apologies if that was not clear.
No, if it was something more sophisticated than that.
No, I didn't mean to go there.
Okay.
We'll get into that issue of data sufficiency later, but I think it's important to address what I did see in the comment letters, a suggestion, the impression by some commenters that the anchored in transactions meant that it could only be transaction-based, that 100% of the benchmark had to be transactions, and that, as Chairman Gensler said, that is not the case. The consultation recognizes that there are low liquidity benchmarks, and that of necessity, if there's not trading, you can use bids and offers, related transactions, extrapolations. But the real issue that is raised, that at some point a diminishing number of transactions suggests that the underlying market is broken, and at that point triggers transition. These issues will be discussed later, but I thought it's very important to clarify that, for example, certainly the S&P Composite, any benchmark that is derived from exchange-traded instruments is permissible, and in fact there was much support for recognizing, as Professor Metz said, that we're interested in focusing on the granularity on benchmarks that are derived from non-transparent information. So anything OTC is in a different situation than exchange trading. So thank you.
Okay. I want to move on to the methodology itself. Thinking of principles in this area, principles regarding a couple of areas: transparency, governance, accountability, verification of data submitted. So IOSCO published that the characteristics of a credible benchmark should be that there should be sufficient transparency over the methodology, calculation, and inputs to allow users to understand how the benchmark is derived and its potential limitations. Curious to hear feedback if you think that's occurring today or there needs to be more done on benchmarks. Methodologies we recognize today differ in strengths and in weaknesses. Some are less prone to conflicts of interest. Some are more able to accurately represent the underlying markets. They're put together differently, whether through surveys, committed quotes, transaction-based. We heard another example from Bill on composites. Some methodologies provide the administrator great discretion in selection and composition of inputs, which I think draws in then judgment and discretion and leaves some question on how a benchmark is put together. What I would like to know is when a benchmark is made up from inputs provided from the market and perhaps voluntary submissions, how much discretion should be allowed to the administrator? How much transparency should the market have or our participants have, and when discretion is used and how that discretion is used? It was a key point that has come up among task force members as we think about these principles. It's a difficult one, but going forward on the principle that you should be able to, as a market, understand how the benchmark is put out and what makes up the benchmark, but yet when discretion is used, how that discretion is applied on a daily basis, I think would be interesting for the market to know. So I'd like to ask, what are the concerns regarding understanding that? Do you want a complete transparency principle, that this should be just transparent and standard when judgment is used? How should that work? And I see Randy's about to put up his flag.
It's a question, because I think it'd be useful, at least for me, maybe others, to hear what you're contemplating with the idea of discretion in the first instance. Because when I first hear that, maybe I haven't thought about it in the right way, but I have concerns about giving someone discretion, certainly in the course of ordinary process of administering a benchmark and calculating the rate. So maybe if you could elaborate on that a little bit, it might help me at least.
I think particularly when there are benchmarks that are derived from inputs from the market, there may be an input that is an outlier of any given day, that an administrator may say, I'm not going to use that input. They're using their discretion to decide to throw out that input. There may be they give greater weighting to different inputs. There may be that they have a lot of not a lot, but a few transactions in hand, but they think committed quotes actually are a better reflection of the day for that benchmark. I think discretion, and IOSCO is not looking to ban discretion. I think that's part of how administrators work in many cases, but yet probably a little bit more robust standards around that discretion used. So I guess my question is really, how much transparency should there be and when discretion is used? Curtis.
So I guess my preference would be when you look at the bond markets, they have a lot of indices, and what we've learned is that those index providers that we allow discretion create uncertainty at certain times, and so I would rather have pre-described sets of rules that I can understand, transparency as best possible as long as it doesn't create any market disruptions. Benchmarks that are well understood prior so that everybody understands how they're constructed, how they're used, are really useful. Those that use discretion, and I'll give you an example of, and this is really kind of dating myself, but Salomon Brothers used to have a benchmark out there in which they did use discretion, and they would surprise the market all the time about which bonds they would put in and would not. And the discretion they used was liquidity. And that created so much uncertainty for people like ourselves that we decided to move away. So my preference is, unless we can understand how that discretion would be used, so that priori we could understand how the benchmark will evolve and move, I would, for one, say that discretion not be used.
Bill.
Bill DeLeon, PIMCO. I agree with Curtis. I wasn't trading that index, but I know exactly what you're talking about at the time. And I think that if you look at the evolution of most contracts and people who use some form of index, they have moved away from discretion. And if anything, they've included fallback mechanisms so that there are prescribed rules. Ultimately, there may wind up being a waterfall where there is some sort of market disruption event, and I'll let Bob talk more about what's in the standard ISDA contracts, where they do contemplate a market disruption or a break. But most rules are written to take as much discretion away as possible. They tend to be of the form of you take a panel, you throw the high and low out, use the average, you go to X. If you get a quote from somebody, if you can't agree, you then do a market poll. There are backup mechanisms, and ultimately there's a market disruption. Most people do not want to be in the situation where there is discretion or someone owns an option. I tend not to want to sell options unless I get paid a lot for them, and you'll see that most people who execute contracts now have the view that the person you're selling an option to will use it against you, so you don't want to give it unless you have to, would tend to be the view. And I don't notice there's no one who's currently on the sell side now here, but I would strongly suggest that that's a bone of contention frequently when you negotiate contracts between the buy side and the sell side. Who owns that option? And the usual move is to not give anyone an option.
Thank you. Julie?
Hi, Julie Winkler, CME Group. I think this is another situation where one size doesn't fit all. I mean, we've been talking a lot about financial benchmarks, but in the case of, many of the energy market and the assessments being made there, there's not as many transactions as we spoke to earlier, and it really does come down to the editor that's in charge of those markets utilizing some of their expert opinion. And so in those cases, we believe that the administrator should have some flexibility. Certainly as an exchange listing many of these products, we're strong proponents of making sure those methodologies are transparent. But we also recognize that discretion is just part of how some of these markets need to work.
Julie, just to follow up on that point, so understanding that the methodology may allow for discretion or judgment used when making the assessment, do you have any issues with then post-assessment describing how judgment was used, or at least detailing that judgment was used in the assessment?
You mean in the case where they needed to deviate from what the plan methodology was in a period of illiquidity, or what?
Or perhaps the assessment was more based on judgment than the underlying data?
I think it would be pretty difficult to implement something like that. I mean, you just think about the 1,000 of assessments that are being done every single day, all of the different markets. If they had to, turn around and provide details on every last decision that they made, I would think that would make people less likely to want to participate, and that, with less participation, you're going to have even less transparency. So I think that would be a difficult role for the market to play there.
Mark, and then, no, Mark, okay.
Mark Seicher from GM. I certainly appreciate Julie's point in terms of not having the expectation that an index provider is going to provide detailed write-ups when either a particular acceptable, one of the acceptable practices for computation within that methodology is employed. But at the same time, following on Bill's point, to the extent that there is some form of hierarchy, let's say A through E, or for that matter, there is some discretion that A, B, C, D, or E could be used. I think it would be beneficial in a variety of ways for a variety of reasons for the at least statistical information to be provided to users. And I think that speaks to where are we on the hierarchy, and do I feel as a user that if, let's say, a large percentage of the time we've moved our way through the hierarchy and we're down to the fourth or fifth option, probably among the least desirable options, yet we're finding ourselves in that situation regularly, we would start to question the efficacy of instruments based on a benchmark that had to be computed that way.
Gary.
Just to follow up on 2 points, one with Bill and one with Julie. So I think to have the transparency in index is extremely valuable, right? To understand what your index is doing during a market disruptions or when there's low volume or high volatility, and what your fallbacks are from an investor perspective, I think it's very important. To create that level of transparency and understand how that potential index can move in those situations becomes of the utmost value. To Julie's point around understanding and not being able to take away discretion, I agree with that as well. Some indexes, obviously, if they're transactionally based, should have no discretion inside of them at all. But other indexes which aren't taking transactional based clear transactions, there may need to be some discretion inside of that. However, those discretions should again be clearly outlined and understood when that is going to come into play in that space. But then you also run into the potential problem of having an asterisk next to an index date, right? Because discretion was used on that specific date. So if you could get to a place where you have a certain level of transparency that's acceptable by the editor of that index, to some degree, and understanding when those happen, you should be able to either quarterly report out that there were 4 discretions used in a quarter, right? So a post-mortem on how that discretion is being used might be something that becomes valuable and gives that market some level of confidence in terms of how that's being used. But to say that the editor-in-chief has full discretionary rights without being able to be audited on that, you end up creating, basically masking a problem that already is in existence, right? So there needs to be some level of balance in that, in having and how we actually monitor discretions being used. Agreed, and concede the point that some indexes will always have some level of discretion involved in making them work.
I think that's helpful, and I think just to wrap up this bit before we move on, I think we have only 5 minutes to get through some other key important topics, but the issue is providing enough transparency that there's confidence in the benchmark and not putting the undue burden of every assessment having to detail how you use discretion. If you do it up front through a methodology, but add it on to some kind of post-mortem. How are these looking? And striking that balance is really what we're struggling with, but some good feedback on that point, and I appreciate it. I wanted to quickly, before we move off this, get to, I have many points, but I'm just going to get to the role and responsibilities of the administrators in benchmark activities. The administrator, we recognize in the consultation document, should have in place robust control framework which would underpin suitable governance arrangements. But the consultation document also proposed that the administrator should have an oversight committee or body to provide independent scrutiny to all activities and the management of conflicts of interest. This oversight body, I'd like to get your feedback on this particular point in the consultation document. Should there, and I guess if you talk about high-level principles and then stepping down to more detailed for certain benchmarks, should certain benchmarks have an independent oversight body that looks at how these assessments and benchmarks are being produced? Gary?
So from our perspective, we're an administrator of the GCF Repo Index. So there is a level of understanding and a level of ownership in that. From an oversight committee perspective, since we're fully transactional based, centrally cleared, full transparency in the number of items on a daily trade count, volumes, et cetera, there's potentially a redundancy in having an oversight committee there. However, it's something that if put forth as a best practice, we would be very happy to consider that. Some other indexes may benefit from an oversight committee that has potentially can look at sort of where there are gaps within the processes or how an index is compiled. So again, it becomes one of those situations where it's truly not a one-size-fits-all solution, but there needs to be some flexibility in understanding that there will be exceptions to where an oversight committee adds value, and there may be exceptions where an oversight committee actually detracts from the value of it, right? There is unintended consequences of having an oversight committee that may run counter in terms of what their intent is to put out for the user index in that space. So again, from our perspective, having a centrally clear transactional-based index, there's less of a support to actually have an oversight committee because there's less value inside of that.
So, Mark
Seicher from GM. I think we would be, particularly motivated to support an oversight committee concept where the administrator may have some, conflict of interest, some financial interest in the value of that particular benchmark. That is, even if it were the case that it's a different part of the firm that's publishing it and perhaps is the capital markets division is writing derivatives that may reference a benchmark that is a more significant conflict that may require more governance and perhaps even governance that is completely or oversight completely independent of that firm.
So I like that Mark just opened up the last topic to hit on, which is a huge one, and it's the conflicts of interest that administrators might have. There could be many principles around how to guard against conflicts of interest by those who put together benchmarks. One of them was this independent oversight committee, but there could be others. And I'm interested in whether there should be just a pure ban on certain entities putting together certain benchmarks. I might know where Bob Pickle from ISDA might lie on that issue. But are there inherently some bodies that are too conflicted to actually produce a benchmark or too invested? Or are there appropriate controls, and what would those controls be in producing such a benchmark? So it's an open question, but looking for your feedback on that. I knew it.
Well, I'm interested in hearing what you think my position would be, Jackie. I mean, seriously.
No, I think when we're looking at trade bodies, those that make up the trade bodies may have a vested interest in how that benchmark would come out on any given day. And without putting the appropriate controls in place, there could be inherent conflicts in doing that. And I'm not looking for an argument other than should there be a line, or what do you think are the appropriate controls? And maybe you have controls in place that we could all learn from and we can
Well, I can tell develop. You that as it relates to the particular indexes that we sponsor, the ISDAFIX, it's run by a couple of outside entities. There are licensing arrangements where they license other providers to use it. And we get a small portion of that licensing revenue. But in terms of where the price is on that index at any particular day, we have no involvement really in that. It's done by the outside providers, and we have no particular interest that's driven by that. So that's the. But I think that as far as sponsorship of trade associations, I don't think that that's inherently a problem. Obviously, our members who are active in the marketplace, who are, in fact, in our case and in LIBOR case, providing the quotes on those particular indices, they may have some interest in that. Of course, they'll probably see.
Can I just interrupt for one second? Some of the members.
Some of the members, yes.
Some of the members
are dealer members.
Are dealer members, but not all members contribute or submit for the indexes.
Yes, the contributors are among the members of ISTA, but obviously the members of ISTA is a much larger community, including our buy-side members like Bill. So that's, so there is that, there is that kind of connectivity, but in terms of actual interest in the rate where it is on any particular day, I just don't see it.
Okay, Rosa?
I think I would disagree with Robert in the sense that I think there are particular type of institutions that should not be administering benchmarks, and trade associations is one of them. Of course, trade associations can play great roles, but in a lot of the uncovered collusive agreements over the last several decades, most often than not, trade associations have played a role. So my view is that an administrator should be allowed when the administrator itself does not have any direct financial interest into the benchmark. If that cannot be done, then I think there's an important role for an oversight committee.
Jackie, I would just add that I don't object to the notion of an oversight committee, and that's a concept that I think makes sense in many cases. Subject to, I know Gary pointed out on his indices, maybe it's not essential, but I think in general, having that kind of governance and structure is a helpful thing.
Yes, go ahead.
Mark from GM. I would say ideally, to the extent that an administrator does have a financial interest in the benchmark, that a calculation agent of sorts could be in certain cases where there is not a particular expertise required that exists in that administrator, but perhaps would not exist in a calculation agent. Conversely, for cases where there is more that expertise of the administrator or like entity is required in a good faith manner to administer that benchmark, that administrator be subject to very, very stringent audit standards in order to the extent possible, even replicate those benchmarks for audit purposes.
Appreciate that comment. It's another idea that we're thinking about is audits. Chris, did you have something before we move? Okay. Yes, Randy.
So, yeah, I think we support the idea, again, someone said it earlier, but not one size fits all on the idea of a governance committee. But we do think when we think about audits and control functions, that needs to, I think, be accountable to some body, and an oversight committee we think is the logical body for that. And again, this is going to vary depending on the size and stature. And I guess as a trade association, our goal is to make sure that these kinds of vehicles exist for investing, for hedging, for market measurement, et cetera, and along the way make sure people have confidence in the integrity of them. I think that's why we're here today.
Okay. Yes, Tom.
I would just observe that I think there is always going to be a conflict between the administrator and the people submitting the data, even if you remove completely things like industry bodies. If it's an index provider that's getting licensing revenue or in some instances transaction-based revenue for the volume of the index, there's a natural conflict there. So I don't think there's anything that could be done to eliminate it. All you can hope to do is to minimize it. And what I would maybe suggest is, rather than focusing on which are suitable entities to be administrators and which ones are not, in order to minimize that conflict, I think one of the suggestions in the IOSCO report is that potentially SRO authority be granted to the administrator. So at the point of contact, they have the authority and the requirement to be ensuring that all the submitters behave appropriately, and that when rules are violated, that they can act in real time to rectify those. That is what we think perhaps the best way to minimize those conflicts and to ensure good behavior.
Go ahead.
Tom, I know that the instance of the LIBOR and Euribor are quite in the news, and there might be additional challenges. The key challenge might be that there's, it may be trying to quote something that's fiction rather than fact, if there's not an underlying market. But my question for you is, do you think that because there's trade associations, in that case the British Bankers Association or the European Banking Federation and Euribor, that it was less resilient, less responsive to the growing problems there? It's just a question.
I think probably. Maybe they didn't have the strongest of incentives to be enforcing, good behavior, but they didn't have the mandate to do that either. So I think, both sides of the equation, by granting SRO authority to the administrator, it gives them the responsibility and the authority to solve the problem.
I think that really takes us right on time, or a little late actually, into regulatory oversight, because now we're talking about which bodies should be granted SRO status, which may already have them. I know the exchanges already do have them, and so in that space this answer might be a little bit easier. But what about totally unregulated entities? And there are many that are administrators out there today that don't answer to any government body and don't have an SRO duty. What should the right line be? The European Commission, as Chairman Gensler mentioned, is proposing regulation of certain BORs, LIBOR. There are other European entities. ESMA is going to do some principles in the meantime regarding certain, again, the BORs. So what should be sort of the regulation, if any, of administrators? And then I'm going to get to submitters, because I think we have two entities here we want to talk about regulation. But what should be the regulatory oversight? And should there be distinctions made, or should we take a broad brush as we've done in the other principles?
And along those lines, the consultation referred broadly to regulatory enhancement and a recognition that one size would not fit all. So the range obviously is a recommendation for direct regulation of certain types of benchmarks and creation of an SRO, reliance upon for those benchmarks that are referenced in exchange-traded instruments, reliance on the existing authority of the relevant supervisor.
Can I take it that nobody wants to speak, that you're fine with government oversight of all benchmarks? Can we just walk away and say that's perfect, we'll regulate everything?
Can I say I don't want that?
Just trying to
look.
Some response.
Let me just observe. What we have in the Commodity Exchange Act is a very important component of this. That anti-manipulation, anti-fraud, but also a provision that says that one should not knowingly put information into a market that tends to affect the price of a commodity in interstate commerce. The false information, so forth. And a commodity, as everyone in this room knows, is not just corn and wheat and oil, but in 1974 it was defined much more broadly and includes all these financial commodities, so to speak, interest rates and so forth. But in Europe they didn't have a similar provision. All three of the cases that we've brought and settled that you've read about rely on our anti-manipulation and disruptive practice sort of provisions, but also this false information provisions. In Europe, they're looking to have direct oversight. And as I said, in December, the UK Parliament already passed. That's what's going to happen to LIBOR. But I gather the European Parliament is also looking at it more broadly, and the European Commission has recommended, I think, that. So this consult is also asking that question internationally. Should this become a regulated activity? And so, I mean, if there's not views around the table, we'll go to the next question. But I think that's one of the key questions we're trying to get to.
And, yeah, Chris.
So a part of me says that we don't want you to regulate everything. And we go to kind of Gary's comment earlier that in new kind of benchmarks, you need to give them time to kind of gain momentum or not. And you might be wasting your time, or they may be creating too big of a hurdle to get through it. But the other side, for more established benchmarks, there is a need for basic principles to ensure that this thing is being constructed in a reasonable way. There aren't conflicts. There's you can look at in terms of compensation. You can look at in terms of who the person, the group kind of reports up to. There's a number of different ways you could see whether in fact it's being governed correctly. So I think there's going to be two levels of oversight, but so this one side says I want you to kind of watch over this. The other side worries that the overregulation of these things will create less innovativeness, less of the things that make America and the financial system really great. And so there's a fear of overregulation and over kind of stifling of kind of innovation. So I think you need to be careful about that. So I don't know if I helped you at all.
No, Curtis,
Like
I think
what
I'm hearing, what I'm hearing is that there's a balance here, and maybe not the broad brush on regulation, but there comes a point where it might need to be considered, that they're broadly used, more ingrained in the financial system, and letting these go as unregulated. Government should take a look, but you don't want to have the stifling, as you call it.
You could you have these comments, and you could also ask market participants and people in a broad base, and they will give you their opinions, and I think you could get the inklings of whether in fact there is going to be some need. So the kind of contact you have with market participants in a discussion and a context of how you go about deciding to create oversight. One was talking about materiality and systemic risk, which is very difficult. But if you could decide that, obviously that's something. But I want to make sure you understand that. I think Gary's point was really good. These many indices are created or benchmarks are created, and you want to let them. It takes a while, and for some of these things, in order for you, the oversight, you're going to require a lot of infrastructure to ensure that the proper things are being done, and you need some momentum for some of these things to grow.
Mark?
Thanks. Just to expand a little bit on Curtis's comments, also have some concern about overregulation, particularly in kind of the market benchmarks. These would be commercially provided benchmarks where institutional investors like ourselves pay a very handsome sum in many cases for that data. And the increased regulation could lead to increased costs, which then just end up being passed on to our membership. But I think it's important to consider the fact that it's a very competitive industry to provide this data, and we can and will switch as we need to if we think that there's a problem with the integrity of that data. So there's a lot more kind of free market forces at work, if you will, in ensuring the data integrity of those particular benchmarks.
Gary?
Just a quick comment. I think to your point, I think there needs to be a level of balance, right? I think for a lot of the indices that are created now, there is some level of regulatory oversight looking at either the entity of the administrator, the index providers, or the inputs into the index. So I think there's some level of balance there that is created already. I think what strikes me as a difficult thing to kind of get to is the point where you move into either being disruptive of innovation, but then having the lack of control of that, right? So it really is, to me, the ultimate question is where would we be all right now if the BBA had SRO authority in Europe to actually look at sort of the inputs there and actually had a bigger stick to walk around with. So there is something to be said for that. There is an understanding that there needs to be some level of ownership and accountability for your actions. And I think as an administrator or as an index provider, as a calculation agent, you need to have that as sort of that first tenor, that first tenant in your space. But you also need the authority to make that decision, right? And you have to be able to pull that brake and pull that lever to say, if I see something amiss, I have the power and I feel like I have the authority to actually make that statement. right? And I think there's going to be, that to me is where we need to get to, where people have that authority, and very much to sort of a whistleblower type of mentality to say, I see something wrong, right? And I need to have that ability to make that action kind of come to fruition.
So in a way, somehow empowering the administrator or the calculation agent to be citing problems when they see it, rather than in this place where they don't. They're just asking for something that they can then turn around and put out.
And that may be part of the oversight committee that we talked to earlier, is that there is an incentive to continue to create an index if you're monetarily reaping the benefits of that. So it becomes a very difficult statement to blow the whistle on your own index if that's where your primary P&L is coming from. So it's a very difficult balance to strike.
Can I just ask this as we go to the other four speakers who are going to answer? My variation on this is just, we've got really strong enforcement authority in the Commodity Exchange Act. We have an IOSCO process that might recommend that there's direct regulatory oversight of benchmarks. I'm just interested, as you go around to do you think we need that in U.S. law or not? And I don't have a view on this. But it's very clear that in the U.K. they've already done it, and in Brussels they may do it. So it's an interesting question of international harmonization as well.
Mark.
Mark from GM. I guess I'm not entirely persuaded that that holding purveyors of indices that are commercially available to clients, that somehow innovation will be stifled by making them basically liable for their representations and warranties to the purchasers of those products. Just about every product you can imagine that's sold through interstate commerce has a significant body of regulation around it, many or most of which don't have nearly the financial importance of what we're talking about.
Good point. Bob?
To follow up a bit on what Gary and Curtis were saying, I mean, Chairman Gensler in his opening remarks talked about the bad actors, right? And that's really the problem here. There were some bad actors. And so it starts there, trying to instill the right, virtues and morals into people who are acting here. That is reinforced through two channels. One is through the structure of the index, how it's set up, oversight committees, and that goes up that level. Then you've got the regulatory backup, which currently, as you pointed out, of course, here in the States, you've got that enforcement power, the ability to go in there and hold people to the law. It's not clear to me that you need to ratchet it up to another level, but both sides need to be reinforced. The structure of the index, the oversight of the index. Part of that could be providing SRO authority to back that up even further. Again, I'm not 100% sure that that's the case, and I think that clearly the actions that you've taken over the last 9 months with the 3 instances to date are a good indication that people need to be very, very careful and precise and moral, ethical in how they deal with the quotes that they provide.
Rosa.
I also fear that there may be sometimes we may end up move towards too much regulation. I think that in particular with respect to the benchmarks we're talking about, it is important to distinguish whether regulation would have a value if we're talking about regulating submitters or if we're talking about regulating administrators. And that ties directly to whether the benchmark is transaction-based and if it is liquid enough or if it is quotes-based. If it is a liquid benchmark, I don't see that regulation would particularly add value. When we're talking about quotes, and in particular, I think that in general, additional regulation could, if appropriate, be beneficial. I tend to disagree with the type of regulation of submitters that was approved in the UK. I think that the fact that submitters will be directly regulated and told how their quotes should be submitted is likely to drive those quotes to be the least risky rather than the most accurate. quotes of estimates of costs. So I worry that that type of submitter regulation will decrease benchmark reliability, will have completely the opposite effect. So I think it is more important to set up regulation in a way that there's an incentive to provide the right quotes, and then somehow, depending on the benchmarks, have some sort of regulatory oversight over administrators. To the point made earlier that maybe LIBOR nowadays is still not moving as one would expect, one might wonder whether the quotes are just being the least risky. Given that everybody knows they're under investigation, they're just taking the approach of providing the least risky, and I don't see why that would not necessarily continue under what was approved in the UK in terms of telling directly submitters by an outsider body how to form their quotes.
Tom.
I think the practical reality, as we've already discussed, is that the lower the level of liquidity, regulation, and transaction volume of the underlying commodity, the greater there is a need for discretion in both how the index is calculated and in how data is submitted. And the IOSCO report talks about selective submission of data. So where there is discretion, there's greater potential for manipulation. Where there's greater potential for manipulation, there needs to be greater regulatory oversight, up to and perhaps including direct regulatory oversight. So given the limited resource of all U.S. regulators, I think it would, as the point Professor just made, not be particularly good use of your time to be spending energy regulating highly liquid underlying markets that are exchange traded. I would again draw that line and focus direct regulatory oversight on the kind of that upper right-hand bracket of underlying illiquid commodities where the potential for manipulation is the greatest.
Go ahead, Randy.
Sure. Just I'll make this point relatively brief because I think it follows along the lines of some of what's been conveyed already. But our view is that those, I realize this is hard to define, but those indices and benchmarks that we would view as having systemic significance in our judgment, those are clearly things that are so important that there ought to be regulatory oversight.
Okay, Tom.
Thank you. In addition to my role at FMC Corporation, I'm privileged to be chairman of the National Association of Corporate Treasurers. And I'd like to give you an analog of another regulatory action about which we've expressed concern that could apply here. The Volcker rule makes proprietary trading bad, but market-making activities are permitted. But just as in this town, one man's freedom fighter is another man's terrorist, there's a gray area between these extremes. And yet, because of the big regulatory hammer that's embedded in the Volcker rule, what we've seen is that capital committed to support the trading in our bonds is starting to dry up. So I would just, everybody around this table has said and acknowledged the need for judgment to be a continuing part of these rate-setting mechanisms. And if judgment is a part of that rate-setting mechanism, and when we saw in 2008, when strict mark-to-market accounting actually created instabilities because there weren't transactions, liquidity dried up, and it created it contributed to instability instead of stability. I think if you impose a big regulatory hammer on the setting of these indexes so that the rate setters are disinclined to use their judgment, you run the real risk of creating an instability that we'll regret when the next black swan event comes. Thank you.
I know that most people try to bring in Volcker somehow. I wasn't sure how it would be worked into this roundtable, but congratulations. That was clever. Joe.
Thanks. It's just to a point that Tom made earlier, and he put it more eloquently than I do, but than I am about to, is that if you're publishing an index, you want to sell something. That's the whole reason you go through the effort of compiling it and publishing it. And I read an article in the local Philadelphia paper recently where they're publishing an index of companies in Philadelphia, the stock prices of companies in Philadelphia that are either based there or have large operations there. And, you know, that's not a financial index. That's just a means of selling newspapers. But that's basically how the Dow started and the S&P 500 started, and it later got repurposed into a financial indice that is really the topic for this roundtable. So you sort of have to ask yourself the question, when does a financial index become a financial index that is worthy of regulation? And the other question is, how deep do you want to go? I mean, the S&P 500, are you going to get into the selection of which stocks make up the S&P 500? It's
No.
Yes, go ahead.
Hi, Bill DeLeon, PIMCO. I just want to, stick to sort of what was brought up earlier, which is the differentiation between having principles and regulation of what goes into an index and how that index is managed versus the regulation of every specific index. And I think if you look at the market, it's succeeded because things get created, they come into vogue, people adopt them, or they go out as a function of whether or not they believe in what the prices are, whether or not there's liquidity in it, and whether it can be traded. And I think if you add on the extreme event of regulating every single index, as Curtis pointed out at the start of this component here, you'd wind up with very few indexes being created because the cost would be very high. Very few people would want to invest in building it, and the buy-in required a priori to someone willing to launch will be very high, which, as we all know, getting buy-in from a bunch of buy-side, sell-side, and providers with a regulatory approval before is a very high burden because people really have to think about something before they're willing to have it submitted. I think that's counter to financial innovation. That's counter to the freedom the market looks for. And as we talked about at the very beginning of this, we're concerned about what's going to happen to IBOR and how it's going to morph. If you have to have whatever it's going to be replaced with, if there's going to be a replacement, highly regulated before it exists, it's going to be very difficult because I think that there's going to be a period of time where there are multiple competing indexes for the market, and there's a grandfathering clause, and there's going to be a whole bunch of stuff going on. And if you add the burden of whatever potential indexes come out being regulated before, not the inputs into them and not the principles being followed, and not that the people who publish are regulated, but the actual index itself, I think you wind up with a much higher burden to move anything forward.
Bill, I actually don't know where the IOSCO report will come out in a month or two on this issue. This was the third one in my list of 5. I don't even know where I come out. But I do think that if any index today tends to affect the price of a commodity in interstate commerce, it's already under the Commodities Exchange Act against the law to knowingly, falsely put information into that would tend to affect that price. So I just wanted to make sure that was,
I'm not
but that's an output issue, and we use our enforcement authority, sparingly. We only use it, we've done this in the natural gas area in 2003 to 2005, and now in these interest rate markets where it's really quite pervasive issues.
No, I apologize. I was not implying getting around any of the existing rules. I was referring to the concept that if someone wanted to come up with a new index for floating rate debt, and as an adjunct to LIBOR, that it would have to be registered and approved. I'm saying that component, I think, is too much. The other component.
So that's helpful. I mean,
so no, I was not implying anything about getting around any other existing rules. So please.
I didn't think you were. There might be some people listening on the phone.
I know with you especially not to say that. So.
No. I just think the integrity. I think that the market integrity benefits from that. Users of indices, even if they're not have any regulatory oversight, but the users of indices know that it's they're somewhere on the books, and Congress passed this decades ago, actually, that, you're not supposed to knowingly put false information into the markets that tend to affect one of these things.
We're in strong agreement on
that's a
this.
good thing. That helps all of you have some confidence. And, of course, we use our enforcement authority, as you've seen, in some of these specific endeavors.
Julie.
I certainly agree with the comments of the other panelists about, innovation and how, too much regulatory oversight could really, dampen that innovation. I think the other point, though, that's important here is just the international nature of, utilization of these benchmarks and also where these index administrators are located. And, I think as we, kind of sit in multiple seats in this, it's difficult to know how all the international regulators are going to come out and where across jurisdictions things are going to fall. And so whether you're in exchange and you are regulated or whether you're acting in your capacity as an index administrator, how that all is going to play out internationally is critically important. There's hundreds of different index administrators out there today. To think that anybody is going to regulate all of them is probably just not a realistic expectation.
And I actually think that there's more duties being put on regulated exchanges through the PRA principal report and through this report that we will issue, because what we said in already an issued and finalized document, the Price Reporting Agency's principals report, is that if PRA, so administrators in the oil space, are not complying with the IOSCO principles, then exchanges should question whether they should be referencing them in the settlement of their contracts. So, in fact, there's more of a duty. These are unregulated things, but there's more of a duty on you as using them in your exchanges if you should be using them. And I think similarly, this report will say if you're going to use these benchmarks in your contracts on exchanges, there's a duty on you to make sure that they're complying with at least the principles. So I think that's a little bit of an onerous on the exchanges. I just want to note that here where we might be saying no regulation, but yet if you're going to use them, you should take note of whether they're complying or not. So it'd be interesting to hear your views if you had them on that, but just noting that. Yes, go ahead.
That sort of hits the question I really had. Chairman Gensler just explained very well what regulations are there, and you can't falsely publish something that is part of the financial indices. So I'm kind of curious to understand why the existing regulatory framework is insufficient and why we need to go further and how we're proposing to go further.
I think the thinking, and as we laid out in the consultation document, is yes, there may be enforcement authorities that many of the regulators have, but that's on the back end. And this is important. Many of these benchmarks are important not only to derivative contracts or to security markets, but to sometimes the larger financial community in a systemic way. Shouldn't they be important enough to regulate at the front end to make sure that administrators are doing what they should be doing pursuant to whatever the international principles come up with or even beyond? So there was a need to kind of have more oversight, like anything that might raise in a good, I think, as Mark said, in a good traded out there in the financial market. So that was the thinking. Was it sufficient just to say, if we happen to find it, we've got you, or should we have more of a front end? Are they important enough to have a front end process? Yeah.
Yeah, but I'm very concerned about overreach. So.
Okay, I hear the point. So listen, I wanted to, we're a little bit ahead, but not really, because we have two of the more meatier topics to come back to, and that's sort of in a transaction-based benchmark, should there be a line on the sufficiency of data in order to make the assessment? And number two, transition. There's a lot of issues around transitions and moving on. So let's take a 15-minute break, and we'll come back and handle those last two topics. So as I mentioned before we had the break, we want to get in on this last hour to two really important issues where we want your feedback and that is sort of sufficiency of data, and then second, transitions. So on the first point, on sufficiency of data, the consultation report went through analysis that when there's a benchmark for where there's an underlying market, at some point there may be insufficient level of actual transaction data. And that raises concerns about whether that benchmark then continues to reflect prices or rates that have been formed by the competitive forces of supply and demand. So while we note that underlying transactions may occur, not every minute of the day, but at least some points, the benchmark may continue to exist. But at what point are there not enough transactions to really have a reliable benchmark? And that's the question to you. Is there some point which in underlying market really, as Gary was sort of going into, dries up and there should no longer be a benchmark? And then we'll discuss what to do about it. But is there a point that may occur? Tribune and then Tom.
Sure. It's kind of a chicken and egg situation, right? I mean, if no one's using the benchmark, then no one's using the benchmark. Who cares, right? I mean, it's I don't see the problem. I mean, but on the flip side, I mean, if you do that with new contracts or new indices, I mean, we might still be talking about the value line listed on the KCBOT instead of the S&P 500, which was before that.
So, Tribune, I think you're right. People may still be using the benchmark, but maybe they shouldn't be using the benchmark. And I guess that's what we're talking about. Is there an underlying market to support the benchmark? And you may continue to use the benchmark, but should you be?
But if it's fundamentally unreliable, what are they using it for? That's the question. I mean,
there could be issues regarding you have a 50-year contract that refers to that benchmark. Very hard to move off of it. Could be that most people are referring to that benchmark. Very hard to move away from the benchmark. There could be multiple reasons why you may still be referring to the benchmark, maybe embedded in many things. So, Tom?
I would say the only entity qualified to answer that question is the market itself. Some of us or some people in the market may look at certain existing benchmarks and say they are obsolete or there's insufficient data to support them, while at the same time there's enormous market volumes going through every single day. So one person may judge it as being obsolete or insufficient, and the market may be saying it's not. I think the point that Curtis made earlier and Mark made as well, that it's a free market. And people can move off one benchmark to the other. Maybe not that easily. Maybe you'd have to go back to your counterparty and renegotiate the reference benchmark. But as a customer, if you ask for that, I'm sure that there is a price. If your feeling is that there is a reference benchmark that is no longer serving its function, that the market will vote with its feet. And I think as a regulator or as an exchange or an index administrator to try to arbitrarily determine that an index is obsolete or insufficient, I think is just very, very difficult. I think the bigger challenge is maybe our next topic of conversation is how do you give the market alternatives so that switching is a viable choice.
Mark.
Mark from GM. I think broadly speaking, there are two circumstances under which an index has ceased to reflect an underlying economic reality. The first one is literally the reality no longer exists. Trivial example, an index that represents where Deutschmark is trading relative to other currencies post-introduction of euro. Those are painfully obvious. The reality simply doesn't exist. The more, I think, difficult or vexing case is where there perhaps is an economic, there remains an economic reality, but the instruments, the transactions, in essence, the proxy that we are using to reflect that underlying reality has changed. LIBOR may be one example of that, where the interbank rate was viewed as a good proxy for bank funding costs, principally because there were a lot of real transactions, and furthermore, banks were significant users of the interbank market to fund themselves. So perhaps rather than declaring LIBOR dead, take a step back and say LIBOR was originally constructed to represent bank funding costs. Instead of looking solely at interbank transactions, let's broaden the categories of transactions and proxies that could be used and bring something like a LIBOR back or a bank funding rate back to what it was originally constructed for and to properly reflect those underlying economic realities.
So, Mark, can I just follow up? So, in your mind, perhaps there would be a point where the benchmark no longer reflects the underlying market, and at that point you need to think, how do we bring it back to be anchored in market realities? I don't want to misspeak or categorize incorrectly, but is that what you were saying?
Yes.
Yes.
Bill DeLeon, PIMCO. I want to, this is a rather interesting problem to solve, and I want to point out one thing Tom mentioned, which is absolutely correct, but I think it's incomplete in the scope of the problem, is it's not only interest rate derivative contracts that refer to LIBOR, where an end user can go and renegotiate the terms with somebody to transform it into some other index. You could do a 10-year fixed rate swap versus LIBOR, convert it into a 10-year fixed rate swap versus index new, plus or minus some spread. We all agree that someone could pick up the phone and do that transaction. The market could decide new indexes, the market convention. What I'm concerned about is, what do you do with securities which have embedded in them LIBOR as a reference rate, as well as contracts, say loans, for example, which refer to LIBOR as an index rate, or indexes which have embedded in them LIBOR for management purposes. Many hedge funds and many real money accounts have LIBOR plus some spread as its target, and as we all know, many of us have floating rate mortgages, and there it's LIBOR plus some spread. Many bank loans are driven that way, and then many corporate issuance is done as a spread to LIBOR, not treasuries, not coffee, not some other index. So my concern is doing a cold turkey event for things where there is no readily known market disruption or commercially way to adjust things is really where things get very sticky. And I understand the concept that you want something to be reflective of the market. You need to let the, as Tom said, you let the market move there, and we also need to consider how do we treat securities or contracts that are not viable to be transformed.
So question is, yeah, Scott.
So one of the issues we've talked about is the competitive effects, letting the market move from one benchmark to another. And the difficulty sometimes is that there are these network effects. So if I'm using a benchmark and everyone else is using the benchmark, if we all agree it's poor representation of what we really like, but that's where the liquidity is, that's where the market is, no one really wants to be the first one to move. When we have these conflicts, one role is for an oversight body, a regulator, some entity to step forward and push the market a little bit and let it sort things out. How do we deal with those tensions and recognize those network effects that are out there?
I think he's getting a little bit into transition, which is fine. Tom?
You want to go there?
Yeah, let's go there, and then I'm going to come back and ask one more point on sufficiency. Go ahead.
Sure. So I would answer that question that the way to do it is with carrots rather than sticks. Are there positive incentives that can be created in new markets? And selfishly, I happen to run one at GCF Repo Futures, which is an index provided by DTCC.
Do you want to depress us here? Do you want to say exactly what that is again?
Sure. Let me start again. So NYSE Life US, which is the U.S. futures exchange of NYSE Euronext, lists futures contracts based on the DTCC GCF, or General Collateral Financing Index, which is a transaction-based index, very different from LIBOR and not meant in any way to be a replacement for LIBOR, but it is potentially an alternative to LIBOR because it is an alternative short-term interest rate based on real transactions in the repo market, so 100% collateralized by either treasuries, mortgages, or agency securities, centrally cleared, highly regulated. So we believe that in this environment that those are attributes that are attractive to people that are looking to trade derivatives on short-term rates, because the subjectivity that other indices are susceptible to do not exist in the GCF market. So back to my answer was, I think all the points that Bill raised earlier about if there are sticks, meaning you're forcing people to move to an alternative index, you get this potential for mismatches between assets and liabilities. You're going to create arbitrarily winners and losers and huge economic transfers that would not be anyone's intention as we're trying to solve this problem. But if there are positive incentives where alternative indices can be promoted and liquidity can be promoted in those alternative indices, to me, I think that's the sensible way to solve it, because we all know that liquidity trumps all. The market will stay with imperfect benchmarks for a long time because they're liquid. And we are trying as an exchange as hard as we can to develop liquidity in our GCF repo futures, and I'm sure other exchanges are going to list their other alternative types of products and promote liquidity there as well. But if there are things that regulators can do to promote that as well, it could only help.
And by promoted, do you want to give a little more to what you mean by promoted?
Perhaps transition mechanisms, and I'd have to think through exactly how that could work from a documentation standpoint that could be streamlined. Perhaps that would be one way. There's been a lot of talk about some of the outside of the U.S. regulatory agencies, governmental agencies that are referencing LIBOR, and to the degree that there were choices given to use either LIBOR and some alternative that could help promote liquidity in alternative indices. But again, you want to do it through giving the customer the choice rather than forcing them or an obligation to move.
Mark
from GM. I don't think we should lose sight when we're discussing LIBOR, but not lose sight of the fact that this problem, that is the representativeness of the index problem, does not exist for what I think to be a large percentage of financial benchmarks. LIBOR falls outside that, insofar as this problem self-corrects, that is, every month or quarter or semi-annually, whether it's equity indices, fixed income indices, because of market cap or shares outstanding or par value outstanding or whatever the criteria are for inclusion of the index, items that for whatever set of reasons, because of mergers, because of whatever set of reasons, either fall out of the index or their weightings are appropriately adjusted. So in some sense, there's a bit of a self-correcting aspect of most financial benchmarks, and of course there are some, LIBOR being included, that perhaps that's less so the case, because again it's so narrowly tailored with respect to not only the participants or the underlying transactions, but also the fact that it represents one manner in which banks fund themselves.
Bob.
Chairman Gensler's remarks at the beginning, he talked about the transition prospective and then retrospective. A couple of things to follow up a bit on what Bill was saying. Derivatives at the end of the day derive their value from something else. That's the classic definition. And
Bob,
so,
thank you very much. Derivatives derive their value from something else.
That's right.
Something else ultimately that has a spot or cash market.
yes, a bond, it's linked to those businesses, and that's why Bill was talking about the need to transition not just the derivatives world, which we've, as you noted, have some experience with in different contexts, EMU, Big Bang and CDS, novations, all that stuff. So we have mechanisms that can facilitate that for the derivatives world, but that's about as far as we can go, and the challenge will be in the underlying. I think in terms of the transition perspective and retrospective, it's kind of like a relay race. It's a handoff. The new rate for new transactions, whatever that's going to be, has to get up and running and up to speed and have a track record before we can even contemplate, I think, handing off for legacy transactions. Because Bill was talking about changing from LIBOR to some new index plus a spread. Well, you need to have some track record over some period of time, and I think it's probably a good chunk of time, maybe as many as 5 or even more years, to see how that differential is seen in the marketplace, so that when and if we can transition, there's a benchmark, a reference to say, here's the difference between old LIBOR and new index.
Can I just mention that in the consultation there was an example, page 47 of the consultation that was put out, that talked of an experience at the New York Mercantile Exchange. So Julie might have some familiarity, but they bought the New York Mercantile Exchange after this. When there was a contract referencing something in the gas markets, which was an RFG contract, but it was a reformulated gasoline contract. And for various environmental reasons, various other reasons, that basis basically went away. There was a new contract that was created, which some of you might be familiar with. We call it RBOB around here. What is this, Matthew? Reformulated blend? I'm trying to remember what. RBOB. Yeah, the reformulated. Well, all right, so I can't remember what all the BOB stands for. But it really took, there's a lot of inertia. The market didn't necessarily move until there was a date certain that the old RFG was going away. There needed to be a deadline because there's tremendous amount of inertia. And even after 10 months of them running in parallel, there had to be like a deadline, and at the end, finally, people moved over from one to the other. Last week in London at the Roundtable, a gentleman who headed up the Baltic Exchange walked us through a number of experiences where shipping rate indices that had been referenced in various contracts, and sometimes they weren't, were multi-year contracts, 5-year contracts, so forth, referencing rates, that the shipping channels and shipping lanes just basically became unreliable and they had to move them. And the administrator in that case would make a decision and run 2 rates, he said, in parallel. And interestingly, when we asked how long did he do it, he said either 3 months or 6 months. It was not 5 years. This is quite a different circumstance than LIBOR, but still, for a period of time, run them in parallel. But he said the longer you run it in parallel, the inertia just, it doesn't move. That for a lot of network effects, my colleague Scott Mixon talks about. So there are experiences, whether it's in gasoline or shipping, it's not in something as large and as systemic as LIBOR, when something fundamentally is no longer referencing a real rate. But I like, Bob, what you said is so accurate. Derivatives derive their value from something. When they were invented 150-odd years ago in Chicago for a farmer to lock in a price at harvest time, the way that the derivative called futures referenced the cash market was through the delivery option. You could actually show up at a grain elevator and deliver the corn or wheat. And even 150 years later, we work very closely with the Chicago board and the folks in Kansas City and Minneapolis about convergence to ensure that and also Tribune, I didn't mean to leave you all out, with convergence, that the cash market and the derivatives market syncs up. Here, the challenge is there may not be any cash market in the interbank market past like the 30-day market. What is it syncing up to? What is it benchmarking? And so to Mark's observation, Mark from GM Asset, that it's not syncing back up once a quarter or once a month. That's the fundamental challenge. That's sort of the challenge for the market and bank regulators and market regulators. And we do, Bill, we absolutely understand that millions of mortgages, approximately half of variable rate mortgages in this country, priced to LIBOR. But if you go to Spain and you listen to the advertisements in Spain about your LIBOR-based mortgages, they're everywhere in Spain, those advertisements. So it's very much a very broad scale challenge. for business lending to mortgage lending, as you said, securities referencing something. At the core,
as well.
if the benchmark isn't benchmarking something, what is it that we have here? And it may be quite unstable. That's what we're trying to get the consultation going from the public market, is to transitions. Do something run in parallel? How long do you run it in parallel? How do you, whether it's, Tom said a carrot, but how do bank regulators and market regulators around the globe ensure for the smoothest transition, recognizing there's costs. This issue is ripe in Canada and Australia. They will move away from Canadian dollar LIBOR and Aussie dollar LIBOR, but those are not $300 trillion markets. It's not the same thing as Spain and so many Spanish mortgages referencing Euribor, or here in the U.S. and the reference to U.S. dollar LIBOR. But it is already ripe in Canada and Australia, so we need this consultation even in that context.
Yes, go ahead.
Mark from GM. In some circumstances, and assume for a moment that you had, let's say, a sufficient amount of data, historical data, that on a pro forma basis you could have computed this, I don't know, fixed to LIBOR, enhanced LIBOR over the past 3 or 5 or 10 years on a pro forma basis. To the extent that let's say, interest rate swaps that a pension plan might use to extend its duration, that enhanced index or reformulated index would have done a better job hedging our liabilities, for example, as a pension plan. We wouldn't need any regulatory incentives to move not only from the perspective of new deals using this alternative construction of LIBOR or a bank funding index, but furthermore, if we had a 30-year swap, we may well speak to our dealers and say, hey, over the next 30 years, since this index would do a better job matching our liabilities, we'd like to in some way unwind or alter this existing transaction to reference the index. So again, from a user perspective, if there's a better reflection of underlying reality, the market may just move itself, even for legacy transactions, towards a better index construction if it's available.
Matthew.
I'm going to just bring up an ugly topic in part.
Can you bring the mic closer to you?
Sure. I'm just going to bring up a slightly ugly topic in part because I believe that it would seem to be rational that you would be already looking at other alternatives. If the 2008 comment by the Bank of England governor says these are the rates that banks don't lend to each other, you'd be thinking about it for years. And so I ask, aren't you all really at risk today for the submitters to withdraw tomorrow from submitting because for whatever reason it's too expensive, too dangerous, too politically at risk, and they just say, tomorrow we're out. You'll have to transition. What would you do? How would you deal with them telling you that LIBOR ceased?
Is your flag still up? You want to try that one? Oh, I was just gonna. Okay, darn. Bob, let's go. Let's try.
Thank you. It's a very good question, Matthew. There's no doubt about that. I mean, to some extent, the banks that are quoting are the same banks that provide liquidity to the market that lend in the underlying markets. So there's a incentive there for them to participate. But I do think that's an issue. And I think some of the recommendations over in Europe have been focused on, requiring banks to remain part of the process, maybe giving them some legal protection. Of course, they have to do it in the proper way, but to participate. So there is that type of protection that could be there to require the banks to continue to quote, but to give them some legal protection if they should do so. As far as, if it completely falls away, and I think we highlighted this in our comment to IOSCO. I mean, our fallback, quote unquote, is really there to deal with the occasional missed quote where you don't publish a rate on a particular date, and you kind of you get enough banks together to give you quotes, reference banks, and you kind of replicate LIBOR on an occasional basis. It's not really there to provide that kind of complete replacement going forward, and so that really would be a challenge.
Bob, on that point, should in the future, should an administrator of a benchmark provide, and maybe even in bilateral contracts, should there be provisions for more permanent fallback mechanisms?
That's certainly something to look at more extensively. I think people, we have I don't know if you've seen our set of definitions for interest rates. I mean, we got a lot more than LIBOR and EURIBOR in there. But of course, a lot of those are just niche markets or particular vendors who have a particular product, and they just wanted to have them defined in the ISDA definition. So there are other things defined, but in terms of the structure of LIBOR, some more definitive fallback could make sense. The question's always going to be, what's that going to be, and whether parties can agree on that.
Gary?
I would vote for the GCF repo index as a replacement. I would vote for the GCF repo index as a replacement. I think would be viable. Seriously, I think there is that risk that exists in the marketplace now if the banks were to go away and stop submitting rates, right? I think as was said down that end of the table, the regulators are keeping the banks there, right? But you begin to wonder, I think, as Rosa said earlier, how accurate are those rates that are coming into LIBOR now, right? Are they the safe rate that just keeps your firm out of the public paper? So there needs to be that thought in terms of how we begin to transition that rate and transition that marketplace to a viable rate. And again, I'll throw out the GCF repo index. That is an overnight interdealer funded market that is cleared, that is fairly liquid and deep, based on treasuries and based on the realities of what the interdealer markets are funding for on an overnight basis, right, anonymously. So there is a substitute rate on an overnight basis, but it doesn't get to Chairman Genslow's point, it doesn't get you out to the 30, 60, 90-day terms. But at the same time, if it's a reference index, it's a value that then becomes discounted or premium for that. So as long as you have the transparency in what that mark is, you can then derive what that rate premium should be on a 30, 60, 90-day, 180-day forward basis. So as derivative markets begin to take off, you could then begin to congregate into potentially the futures market to kind of come back and kind of reinforce what those long-dated rates would be. So that was my 30-second PR plug. Thank you.
Thank you. I don't know, Matthew, did you have a follow-up on? Yeah, go ahead.
I have one quick, very short question for you. You used the word, and I've used it before, and I didn't say anything, but I'll say it now. You used the word safe rate. Is a safe rate a real rate? Or is a safe rate something that everyone will just let you skate on, but is actually false information?
And I think, just to be clear, we were talking about the LIBOR submissions for that safe rate, not my submission. So for me, it's very difficult because how are you going to define what you would deem what we've been quoting as a safe rate? Can you borrow in that rate? And I think it was fairly clear in 2008, as you quoted, those rates haven't been executable, right, in a true market for quite a number of years now. So that safe rate for effectively was artificial to begin with. So, but what it did derive is potential profits for other banks, other investors off of that rate. So people began to, again, premium or discount that LIBOR rate. And whether that was understood as a safe rate or whether that was understood as an accurate rate, I think some market participants had more insight to it than others. So I don't know the answer to sort of what is that rate. To me, it's a rate and it's a number. And that number is set by the 16 or so banks that are setting that rate. The integrity of that rate, as we all know, has been in question recently. So how do you begin to move off of that? And my view moving off of that is coming back to a rate that is transparent, that is cleared, that is in a deep liquid marketplace, that has the sustainability on a long-term basis. And if you talk transitionals, going back to, again, my GCF repo rate, there is historical data that goes back to through 2005 and beyond that rate can be recreated for, right? So we weren't posting the rate during the financial crisis, but we can give the exact rate that would have actually taken place during the financial crisis in terms of what the dealers and the banks were funding themselves for on an overnight basis during that complete period. So there, again, transitionally speaking, there is a potential alternative, as nothing is perfect, but there is a transitional period that can happen. And I'm sorry I didn't answer your question. I can't define what a safe rate is.
Okay, Tom.
Thank you. I went back to the future, and as Chairman Gensler mentioned at the beginning of our discussion, I went back and dug out a credit agreement that I negotiated back in the early 90s for Scott Paper Company. And at that time, we did not use BBA LIBOR. We didn't use a LIBOR index. We constructed our own index. And that index was 3 reference banks chosen to be representative of the overall bank group in the credit agreement. It was their LIBOR. So that's a mini index within that one bank group. And we also then had a spread over that LIBOR, and we had a different spread over a CD rate that was similarly determined by these reference banks. And so there was an inherent stability through the arbitrage available to us as a borrower and everybody else that had that structure to cause a convergence, since either the LIBOR rate or the CD rate was meant to reflect the bank's cost of funding itself, and the spread was meant to reflect Scott Paper Company's credit risk over and above that, the combination of which would compensate the bank group for making loans to us. If the LIBOR rates quoted got out of whack with the CD rates, then we would just elect the CD rates, and through that convergence mechanism, we would have stability in there. So I think somehow in this whole discussion of transition and how we get there, part of it is that I think Rosa and Joe and I, when we get together with our other treasurers at our meeting, we're going to talk about why we're not negotiating for provisions like this to be put back in our loan agreements, because we think they're, as we've talked about it, they're inherently provide more stability than the present arrangement.
I think your word is a key word. I think, unfortunately, where the world has gotten, where we've all collectively gotten, is not that stable. When, as Bob Pickle and others have referenced, where banks are being asked, requested to quote something that might not even exist, but to quote something, and that there's this concern, as Matthew Hunter pointed out, as to what if they didn't quote. That's not a particularly stable place for the financial system, and it's particularly challenging if $300 trillion of derivatives are quoted to it and $10 trillion of loans and mortgages and so forth are quoted to it. That I think that we all together, bank regulators, market participants, and market regulators, need to try to find our way to get to a more stable, much more stable place than where we are right now. So I'm picking up on your word, and I encourage your group, if you can find, that's the prospective transition issue, how to embed in your new loan agreement something that's more stable. But Bob, you had your flag up.
But Mr. Chairman, if I could just, so from the point of view of a treasurer, we're going to be asking why we don't build these back in. But the other inherent stability providing a feature of the old arrangement was that the overall bank group we had was, I think it was 22 banks at the time. So 3 were chosen to be the representative banks, but they bound the bank group to the rate that they quoted. And to the extent that it was out of whack and not representative of the funding costs of the other banks, there would be a challenge within the bank group, and perhaps one of those reference banks would be replaced with another bank deemed to have more representative quotes. So there was a two-way convergence that was provided through that whole mechanism.
Yeah, so I think what you're saying, what I find interesting, is there was that second mechanism, that there was, amongst the bank group of 22, there was some self-policing. It's like living in a small town, in a small village or a small town. There's less prone to misconduct because the community keeps you in line.
Yes.
But here we have something that millions of people around the globe are using, something that's set quite distant from them. It's just, presumed to be reliable, and now we've found out, I think we've found out that it can be, readily and pervasively rigged. And then we look at market data and we say it seems to be, not connected with what you might find in other quotable rates and quotable markets.
Bob.
Yeah, I was just going to add a brief comment on the concept of fallbacks, not just in the rates that we publish, but also in other aspects, market disruptions. What happens when when a market disruption happens? How does the contract settle, or how do we amend? How does the contract go forward? So we have a lot of experience in the past with those types of market disruptions, fallbacks, and we find two things. One is it helps to have something in the contract so people know if nothing else happens, if we don't agree a different path here, this is what we're going to have to do. But it also focuses people to say, all right, if we don't like going down that path, we better figure out very quickly what else we do. This kind of is in contrast to my transition period to a new rate. Seeing a rate go away could obviously focus very quickly on transitioning, but that's really just in the derivatives world.
Bob, can I ask you whether you use the Baltic Exchange 3 to 6 months or your 5 years is not the center of my question, but how would you actually run a transition, whether it's your 5 years or their shorter period? How would you do that?
My transition was really more focused on, whether it's a new rate, whether it's the GCF rate, which has something of a track record, to have something that market participants who are used to LIBOR can look and see, how is a potential new rate different from the LIBOR rate I've always used. So that's really the transition. In terms of actually if we could agree in the marketplace that for legacy transactions, we're going to amend them to a new index going forward, I think you'd have to figure out what the differential might be, as Bill was suggesting earlier, what that new index would be, whether there'd be some compensation between the parties as a result of moving from old index to new index. In terms of actually amending the contract.
Can I just ask a question? Would it have to be one size fit all? Could it be some might like the general collateral financing rate or GCF rate, and others might like something called the OIS or overnight index swap rate, and maybe thirdly, maybe some others want to move to some sovereign yield curve? I mean, does it have to be just one?
It's conceivable that you could do a menu of choices that parties could opt for, but the way we facilitate that amendment process is through one of these protocols, which we're running now for all the Dodd-Frank changes, and that kind of assumes that works best when everybody kind of moves in the same direction across the board. It's harder to tailor it to specific situations. We did it a little bit in the original EMU protocol, but that was a very limited instance. Generally, we're trying to move the whole vessel and change the direction into a new direction.
Gary, I think it's important to accentuate what Bob's talking about. It doesn't mean you couldn't have multiple instances of replacement items, and that on a bilateral nature, people couldn't enter into different forms. But I think if you want to have a mass conversion, there's only going to be one. It doesn't mean that prior to that conversion date that some people could decide to go from LIBOR to OIS, some people go from LIBOR to T-bill, some people go from LIBOR to whatever they want. But if you're going to have a mass mandatory conversion, it's going to only be one item. You could have conceivably multiple indexes existing, which we already have, and then you'll have basis swaps and different forms of liquidity. But the market tends to want to pick one winner for liquidity, or if there's a mass event, you're only going to make one. You're going to go from one ship to the next ship, and then after there, you're going to decide where you're going to go.
Rosa?
Yes, in the subject of liquidity and ability to trace alternative ways of funding, seeing how banks are funding themselves, has anyone looked into time deposits or certificates of deposit as an alternative? I mean, banks are not lending to each other, but they are raising funding through consumer deposits or large corporate deposits, and those rates are published. So does anyone have a comment about that as an alternative?
Richard, you might not have meant to put your flag up, but did you, you have a comment on that, or should we look around the... Okay. I'm not sure we have, but... No? Anyone else? Okay. Richard, I know had another comment, so go ahead. I don't know that we have a comment on yours, but good consideration. Go ahead, Richard.
I have actually a follow-up to something that Mark had said earlier. And that is, you said that if there existed a benchmark out there that was a better fit for your assets and liabilities, that you would naturally move to that, right? I take from that that benchmark does not exist, that it's a hypothetical benchmark. But one thing, and liquidity has been thrown out. I am curious what characteristics you would look for to determine whether this, in fact, is a better match for assets and liabilities.
Certainly from the derivatives perspective, as a pension plan, our principal and overwhelming use of derivatives is to hedge our gaps between assets and liabilities, whether they be foreign exchange, whether they be credit, whether they be duration. For virtually any pension plan, extending duration, so both interest rates as well as credit, tends to be where the largest gap exists and thus the largest amount of volatility that accrues to the balance sheet of the plan sponsor. So if we were to find, so in essence in the rates market, and that's really our biggest risk by far, if we were to find an index that, that by and large could give us both a rates component, call it a risk-free rate component, as well as a spread component, and that spread component would be as similar to AA corporates, because that's, in essence, from a regulatory perspective, how our liabilities are discounted. That, in essence, would be optimal. Now, prior to 2008, the basis, that is the difference between, in essence, the LIBOR spread to treasuries and the AA corporate spread to treasuries tended to be fairly small and not terribly volatile. So LIBOR had basically by and large the two characteristics that we were looking for: the rates as well as the spread component, or at least sufficiently good. Now that divergence is creating headaches and stomach aches for us. So to the extent that an index that has those properties existed and we could transact in long-dated derivatives, that would be optimal.
So I have a question, and we've danced around it a bit, but it's the legacy contracts. So I would like to know, in your own, it's coming back to Matthew's kind of scenario, which is if today you couldn't use LIBOR, you couldn't use another benchmark, which you're referencing, what do you do about your legacy contracts? So if we were to develop principles around legacy contracts, what would be best practices to transition for legacy contracts? Anyone? I know it's a hard issue. Bob?
Yeah, well, I thought we've kind of been talking a bit about that. I mean, Matthew's scenario is the disaster scenario. If tomorrow morning we wake up, there's no LIBOR. We would have to deal with that situation, try to get reference banks, virtually impossible to do if even on one day, let alone for the foreseeable future. It wasn't really put in there for that long-term failure of a rate. So I think that, we'd have to focus very quickly on a new rate. In anticipation of that, we can talk about what a potential new rate might be. We as ISDA focus on, ultimately following up on what Tom and Bill and others have said, the market will kind of tell us what that rate is, whether it's some existing rate or some new rate. And then it's, as ISDA, we focus on facilitating that move from one rate to the other. But we're not going to be there to say this is the new index for people to use in place of LIBOR going forward. It's really ultimately up to the marketplace to decide that.
Can I ask about one rate, just the OIS overnight index swap rate? I think is somewhere in the order of 15+%, and the London Clearinghouse. I'm sorry, CME, I don't know your figures, but you probably might know, Julie, what it is. But so it is it's the second largest reference rate, actually, beyond LIBOR and U.S. dollar in LCH's clearinghouse. I guess that probably means LIBOR is 85%. So it's had some market take up. I'm told that it's mostly, not entirely, dealer-to-dealer swaps and less dealer-to-customers and users in the corporate world. Possibly haven't even started using it, but some hedge funds are trading it. I'm just curious if there's any perspective around the table as to why is there, whether it's 15 or 18%, I can't remember, but why has there been some take up in that, but more in the dealer-to-dealer area and less, and some dealer-to-hedge fund, but less elsewhere?
Tom.
What we hear from our customers about about OIS is the floating reg of OIS is Fed funds, and Fed funds is suffering from many of the same withdrawal of liquidity issues that LIBOR is suffering from. I believe the daily notional turnover in the Fed funds market has dropped from something approximating $250 billion a day pre-crisis to something like 50 now. And the reason that we launched our GCF repo futures is largely in response to the lack of liquidity and the withdrawal of market participation in the Fed funds market. And customers were looking for something that was still active and liquid and deep and reflective of true funding costs in the market. And people felt that Fed funds and feel Fed funds is no longer serving that purpose. So to the degree that Fed funds is broken, OIS is broken. Now there's a new market that I'm sure you're tracking as well called GCIS, which is all the same mechanisms of a OIS swap, but using Gary's GCF repo index as the reference benchmark instead of Fed funds. And that market's about as new as our futures market, although it is growing quickly.
Just before we go to Rosa or Mark, Tom, do you know what the daily turnover in your general collateral, if the Fed funds is down to $50 billion a day, do you know what your general collateral is a day?
Our futures are relatively new, so I think the question is probably better for the underlying. I think Gary might.
Market.
So we're doing roughly between, on the underlying, across three indexes, probably between 300 billion on the underlying.
How much?
300 billion.
300 billion of underlying general
funding,
collateral.
yes.
Funding. All right, sorry. Rosa.
The question on whether some contracts or transactions could move out of LIBOR to OIS really depends on their purpose. Under normal economic times, the spread of LIBOR over OIS is fairly stable and small. What happens during a financial crisis, and particularly one in which the Fed injects a significant amount of money in the economy, is that there is an expectation by the market that quantitative easing is going to continue. And so the OIS is an expectation of future Fed fund rates and has been decreasing significantly over time. On the other hand, LIBOR decreased for a while, but did not decrease as fast. And LIBOR adds a component of counterparty risk over OIS, which is, I believe, the greatest value of an uncheated LIBOR, which is the difficulty that other benchmarks have, is that they have, to my knowledge, there isn't, and I am not as familiar with the new benchmarks you have been discussing, but there really isn't a well-known benchmark out there that can isolate the effect of counterparty risk.
Mark.
Mark from GM. I would just, I guess, reiterate my comment from a bit earlier that OIS, we've done a little bit of work. There's a limited history of OIS swaps, but unfortunately for the reasons cited by my fellow panelists, OIS or even the GCF rates are not likely to provide us with the spread component that we'd be looking for to hedge liabilities. Now, we could conceivably hedge in two parts, that is, hedge a pure rates component and then find perhaps other instruments, whether they be in the cash markets or in derivative markets, to hedge the spread component, and perhaps we could do it separately. So that's at least one contingency plan we could have.
It wouldn't be identical to what LIBOR once was 20 and 30 years ago, but what either the overnight index swap OIS or the general collateral rate or even possibly a sovereign yield curve, Treasury bill rate, would come closer to what the IOSCO task force has already said about being anchored in transactions.
For sure.
Even if it's 50 billion a day, or as you said, maybe 300 billion a day, that's real transactions. Whether you, in most towns, 50 billion, 300 billion is real transactions. With the challenge, particularly given the changes in the Basel III Accord and the liquidity coverage ratio and so forth, it's not readily apparent whether banks are going to lend unsecured to each other for 3 months, 6 months, 1 year, given some of those rules. Mervyn King's quote keeps ringing in everybody's mind, so to speak.
Bill?
Just one thing in terms of market structure. We've talked a lot about rates and reference rates. What is interesting to note is that since the crisis, the market has moved 180 degrees from one of lots of unsecured trading and lending to almost all trading being or going to be collateralized on a daily basis. What do I mean by that? Well, futures have always been collateralized. OTC ISDA transactions have been collateralized to some extent. However, now you're seeing them more and more being, almost all transactions being collateralized. TBA, forward settlement mortgages, are now moving to be collateralized, and then starting this summer, with the TMPG, they're going to be going there. So there's been a massive change in market structure where lending is almost always either outright at very credit-sensitive spreads, or it's on a collateralized basis with haircuts. So I think there's a massive change in market structure accompanying the fact that LIBOR's change as well. So there are two things going on that I think a lot of people are also grappling with. So not only do you need the liquidity of a new instrument to supplant things, you need to have an understanding of what does it mean, because now everything's secured. And I can tell you that at PIMCO, almost everything we do is secured or outright lending when we buy corporate bonds or things. So it's a very different structure.
Richard, you had a question?
Yeah, I actually wanted to go back to the question about CD rates, which I think I was the one that steered the conversation away earlier. Acknowledging that there certainly has been a move away from unsecured to secured, the activity in Eurodollar contract and all of that seems to say that there's still a use for unsecured lending and unsecured benchmarks, right? So I am curious to see if there's appetite or use for an expanded definition for unsecured lending, let's say into something like CD or CP rates, or other types of unsecured lending.
When you're considering that, Bob, would that be a frustration of contract under whatever lawyer's opinions you've gotten around your current ISDA definition?
Depends on what you want to do, whether that's just something to develop and nurture going forward. People talk about, people said, our definition of LIBOR actually says whatever's on that screen on that particular day. And somebody said, well, they could put any rate up there. I said, well, people would begin to say that's not really the rate if somebody's completely, if it's a completely different set of inputs that's going into the rate that's there. Nobody claimed back in the late 90s when the BBA changed the question that they asked the banks from what are prime banks in the London market lending at to what can I borrow in the London market. Nobody suggested that that was some fundamental change in the rate, but I think if there was some, if all of a sudden we started publishing, or Reuters started publishing CD rates on the LIBOR page, people would say, well, that's not really exactly the contract I entered into, and they would argue these questions of frustration, which are a concern. That's why, we have to look at providing some mechanism for the parties to agree, if we get to that point, that they'll move from old to new on some basis.
Julie?
Yeah, I mean, I think Bob makes a good point. I mean, we all, I think, are in agreement here that there's been, some significant actions taken by the Commission and other regulators in terms of LIBOR, but there also have been, some sizable changes that have also been put forth at making that a more, reasonable benchmark and reliable benchmark. The Wheatley Review, the Hog Tendering Committee, and all of the actions that they're taking now, are trying to address that with a number of different, ways of governance, code of conduct, and now have a more robust regulatory framework around that. So, I think we're looking a lot in the rearview mirror, but there are also a lot of changes underway to solidify that benchmark going forward.
Julie, I thank you for raising that. I agree with you. I think that Martin Wheatley's report, I think what will come out of this IOSCO report are very hopefully positive steps forward on governance, on conflicts of interest, on administrators and submitters. The challenge, I think, collectively is once those are all in place and Canadian dollar LIBOR goes away and Aussie dollar LIBOR goes away, is there a reliable underlying market for U.S. dollar and sterling LIBOR and euro LIBOR beyond maybe 1 day to 1 week, these 3 months, 6 months, and 1 year. And if the banks truly aren't lending to each other because of what Bill Leone says is just a fundamental change in market structure these last 5 years and a change of the Basel capital rules and so forth, we're really in a challenging spot where we've done a lot to address governance, which I fully endorse what you just said, but you're still left with a pretty unstable question as to how do banks quote something that doesn't have an underlying market and doesn't have it maybe more than a week or two. It doesn't have it for months or years at a time. That's the one that we might not necessarily answer it in the IOSCO consult, but I think that's what collectively market participants and bank and market regulators have to grapple with.
I failed to recognize, and here I am at the very end, that we may have task force members participating by phone. So forgive me if you wanted to speak and you're on phone and you wanted to speak earlier. I didn't pause to see if you had a question because this is, of course, although hosted by the CFTC on behalf of IOSCO. So let me just pause for 1 minute to see if anybody on the phone wants to take their phone off mute and ask a question. Okay. I think that's it. So we're sort of at the end. I want to make sure that the participants had the opportunity to say what they wanted to say, that they got out the point that they wanted to make. If you didn't, raise your flag now. Otherwise, call us separately. This isn't the end of it. You can continue to send your comments, but do it quickly because we do have a time frame. I hear somebody on the phone, so let me just pause and make sure that wasn't somebody who wanted to come in. Okay. Oh. Is there somebody on the phone, or are you accidentally off mute? Now please put your phone back on mute. Force muting. Okay. Julie.
I think one just question I think that many people in the marketplace have is just how this is all going to play out from here, and I don't know what guidance you can provide to us given what you have done on the oil PRAs, what ISMA's out doing now. I mean, what can we expect? I think that uncertainty is causing some challenges for people now of what they need to be following and what the time frame looks like.
So IOSCO was originally shooting for a March final report. That proved to be really ambitious. And as you will note from our consultation document, we didn't actually consult on the principles themselves. And the task force met last week, decided that it was really critical that we give more time to consult on the actual principles. So that's what we're going to do. We'll have one more round. And I know some of you have just changed the name, maybe not you in this room, but we've noticed that some people say, forget to change ESMA or EC to IOSCO. It's been multiple consultations. We recognize that, but it's important, and these will be the actual principles, so you'll actually have some meat to comment on. So we're going to consult one more time on the principles themselves, probably, don't promise this, but March, April timeframe for final report. late spring, early summer. G20 released a communique asking for it by the end of the year. We'll be definitely way before the end of the year, but that's roughly the time frame. So final report for then May, early June at the latest is what we're shooting for at this point. Okay? So
Translating that, Jackie, you're envisioning, I'm learning too, so you're envisioning that we would put out to public consultation much of this. It would talk to the scope, the governance, the conflicts, the administrator piece, and so forth, and the principles, but get further public input. We'd put it out, as you say, in either March or April, but we'd put it out, but then try to close it out sometime late spring, early summer.
Right.
But that's just this one piece, Julie. I mean, the IOSCO piece.
So I want to thank you for your contribution before today and then today and on your ongoing contribution to this. This is a massive undertaking by IOSCO and the national regulators around the world, so this won't be the only time. We'll probably come back to you and ask you for further guidance. I'm going to turn it over to the chairman to actually say a few remarks.
I want to thank you. I mean, it's interesting to me, of the 23 roundtables we've had, this is actually not the most attended. But it may, in fact, be the most challenging. I know that some of the topics that we've talked about here might not even be that popular, partly because it's at an end of the markets that not a lot of the public focuses on, the short-term interest rate markets, and that which Tom Dees talked about in the Scott paper, lending agreement from 20 years ago. Most people in the public don't have a reason to, to address. But I think that we're all faced collectively with this challenge that maybe collectively we've all inherited, but it's not a particularly stable place to be. And I think we benefit, the CFTC for sure, and IOSCO benefits from your continued input, not only on these principles and the scope of this report, but also on this challenging issue of what do we do in Canada and Australia, or what do we do prospectively, prophylactically maybe, to make sure that there's fallbacks in contracts that are entered into, new contracts that are entered into, and then this overall question about the legacy transactions. I personally believe that markets work best. They're more stable and there's more integrity when they reference real price discovery and real transactions. I think this is an intersection of stability and integrity. That collectively, if we keep the discussions and seriousness of purpose together, we'll get to a better place. But I do recognize there's a great deal of inertia that might not want to address these things. But I think if we don't, we'll leave the world still unstable. But I want to thank you and encourage your continued input, not only to us, but to the bank regulators around the globe that are looking at this as well.